we're going to start with some earnings from Tailored Brands, and the rough week for apparel just gets rougher. Tailored Brands is the parent company of Men's Warehouse and Joseph A. Bank, and that stock is down 27% this morning on third quarter results that on the surface don't look as bad. They don't look 27% negative bad. They don't look great, but you tell me what's going on here.
Well, Chris, you're going to hate their guidance. I guarantee it. Really, in all honesty, that's what it is. I think, to your point, that the results for the quarter were not really bad at all. They met or exceeded the expectations, but it is really about the forward guidance. They guided down from previous goals, and we know how the market tends to receive news like that. This is an interesting comment. I think for the two to exist together like this, it probably makes the most sense.
Joseph A. Bank, and Men's Warehouse.
I think they do very similar things, and so you might as well just exist as one strong business, and it's as strong as could probably be in the environment. I think the biggest challenge they faced, really, though, is this secular move away from business attire, right? I mean, I think more and more places are just adopting these casual work environments where the expectation doesn't exist like it used to, where you had to dress up and wear a tie or a suit to come to work. I mean, I use us as an example, but you and I both know from companies that we see and talk about all the time that more and more companies are just adopting that sort of casual environment there. So I think that's part of the challenge there. Now, it's not to say they can't deal with that. I mean, they can come up with new types of offerings and maybe steer away a little bit from that formal business attire, but retail is very difficult. And I mean, they have a bit more than $1.1 billion in debt on the balance sheet. So when you have that, along with a company where the top line is essentially just hit a brick wall and margins are now beginning to compress, their biggest challenge, as noted in the call, is getting more people in the stores to buy stuff. Well, I mean, the only way you can really do that is to offer more deals, entice them to come in and buy more stuff. That's fine. But what that ultimately does is plays out on margins, and then you condition your consumers to essentially wait until stuff goes on sale. So it's kind of like that Bed Bath & Beyond scenario there. Granted, I think I'd probably find myself in a clothing store before I'd find myself in a Bed Bath & Beyond store, but I think there's a parallel there.
I'm glad you mentioned the secular decline in business attire, because that was one of my thoughts when I was looking over this news this morning, was sort of extrapolating my own life and the attire here at the company. I mean, there was a point in time where I had a bunch of suits.
Yeah.
I don't anymore.
I was the same way.
I don't need them.
Yeah.
And I'm wondering if, because in some ways, maybe it is helpful for Tailored Brands that the pathway ahead of them for success, while not necessarily is easy, I think it's clear, and I think you hit on it, which is they need to start moving away from suits, and they need to start offering more casual clothes. And there's a lot of brand work that has to go into that. And I know that for a lot of people, that's sort of a squishy thing. But more specifically, I think that if they were to undertake maybe a 2-year campaign to say, look, not only are we going to expand what we're offering in terms of clothing, because one thing going relatively well, I think, for Tailored Brands, certainly in the case of Joseph A. Bank, nobody looks at their offerings and says, well, that's bad quality stuff.
Yeah.
No, they sell quality clothing. So I think if they were able to expand that sort of down the scale away from the suits, more towards Banana Republic, and start eating into Banana Republic's turf and that sort of thing, and along with that, doing the marketing spend that they would need to do to really move that brand perception. We're not just suits. And by the way, we're not just suits on sale, as you said. We offer all range of clothing for men.
Yeah, I mean, become more things for more people. And I mean, we say that a lot, but in this case, it may very well be the easiest way to continue to grow. I think about brands that exist out there today that could perhaps complement what these guys are doing. And one that comes to mind is, have you ever heard of Untuck It?
Yeah.
So that's the brand, essentially the shirt built on this notion that we guys are tired of tucking our shirts in. And so you've got these button-down shirts that are tailored just so that they hang just the right amount below the belt line, and it looks classy untucked. I mean, maybe they need to think about bringing a brand like that under their umbrella. Maybe there's an acquisition to be made there at some point to be able to offer more breadth to the catalog there. But again, the problem still exists. They have a big slug of debt on the balance sheet, and so you have to account for that. If they decide to issue shares, will that dilute shareholders? So, I mean, they are in a little bit of a predicament because of the financial position that they're in. It's not dismal yet, but I mean, it could get there pretty quickly if they're not careful. So
we're a couple of weeks away from our annual tradition on Motley Fool Money of our first show of the year, the calendar year. We do a preview. And I'm just going to go ahead and say my prediction for 2019, my business prediction, is private equity comes in to Tailored Brands, because this is a viable business that is stumbling right now, and it is a $700 million market cap company. Mm-hmm. This, if I'm somewhere in private equity land, people are looking at this business. They're listening to what you're saying about Untuck It and those types of moves into casual space, and they're saying, rubbing their hands together with glee, we can fix this, but we need to start buying some shares.
I think that's a reasonable observation. I mean, if anyone's looking at this company right now, is a pretty darn good time to do it.